Good evening. Welcome. Good evening in New York and in the East Coast of the United States. Good morning for those of us who are joining us from Hong Kong or China or other parts. James Heimowitz, I'm the president of China Institute, and it's just a delight and an honor to introduce this evening's program. We're in for a special treat, learning about how China's financial sector, the challenges, and what we face going forward. It's interesting. I just spent this morning actually and yesterday helping U.S. legislators to better understand the present situation between U.S. and China. Recently, actually happy to share, was with Senator Tammy Duckworth, Democrat from Illinois, and I was explaining that I feel there's so much misunderstanding. She was particularly talking about anger and hatred directed towards Asians in America. And what I said was I felt that a lot of this was due to ignorance, and that one of China Institute's core missions is to help educate people, to shed light on what's actually happening in a place like China. And I can't think of a better conduit for mutual understanding and a better conduit for having engagement, doing well, doing good, and having both sides engage with each other than through finance, commerce, and business. And that worked for a really long time. It worked for nearly 2 decades as Americans sought to access markets in China, and then subsequently as Chinese companies, particularly financial institutions, sought to, as they became more sophisticated, open up and engage with US. And I'm extremely hopeful that as we move forward, we'll see further engagement and further developments, particularly in the area of finance, especially since that's where I got my professional start. So you didn't come to listen to me. I just would encourage any of you that's listening to think about the mission and the vision and the values of China Institute in the belief that engagement is the path forward for creating a better planet for us, and in the belief that the United States and China have the most consequential relationship on the planet, and on top of which that financial systems and financial enterprise is a key component to that connectivity. So without further ado, I'd like to hand over this program to Dinda Elliott, who has masterminded all of the public programs at China Institute. And for those of you who aren't familiar with her fantastic work, you're about to get a treat tonight with Li-Gang and with Andrew. So why don't I ask Dinda to join us now?
Okay, thank you. So we are so thrilled tonight, as James said, we're so thrilled tonight to have 2 real experts on China's financial markets. We have Andrew Collier, who is founder of Orient Capital Research and the former president of Bank of China International USA, which is kind of an amazing detail. And we have Li-Gang Liu, who is chief China economist at Citi Group in Hong Kong. He also worked at ANZ Bank, the Asian Development Bank, and the World Bank, and many other institutions. So just to quickly set the stage for today's conversation, according to a Peterson Institute paper by Nick Lardy and Tianlei Huang from last year, the total assets of China's financial sector stood at $48 trillion, an enticing number for international financial institutions. And yet, because of many, many restrictions, foreign firms held only a tiny sliver of the market, less than 2% of the banking market and less than 6% of the insurance market. Regulators announced a few years ago in China that the country would open up the financial markets to majority foreign ownership. And so tonight we're going to look at what has happened since. So with that little background, Li-Gang, let's start with you. Firstly, welcome Li-Gang and Andrew. So wonderful to have you here with us. We're delighted that you're here early morning Hong Kong. So thanks for joining us.
Thank you.
So Li-Gang, let's start with you. I wonder if you can help set the stage for this conversation a little bit and tell us what has changed in terms of China's restrictions on foreign financial firms' access to the China market.
Yeah, first of all, I'd like to thank you for the invitation. Indeed, this is a very prestigious institute, with a long history, and perhaps a lot of those Chinese who came to the United States want to enhance the exchange. Now we have been seeing very intensified exchanges, especially in trade, and I would think that finance will be the next stage. Indeed, China's financial market opening has been very much delayed. During the China's entry into the WTO, there was a lot of fear that if China were to open its financial market, wolves will come and China's banks could not compete. But after so many years, we did not see that. As you mentioned in your statistics, indeed, the foreign financial institution is small group in the Chinese financial market. I think the reason for China's recent push for financial liberalization or opening up are mainly because of its own initiative. I remember it was first announced in February 2016. At that time, the renminbi was under pressure. China was suffering from large capital outflow. Perhaps, the policymaker at that time was thinking that by opening up its financial system for foreign participation, China can re-attract more capital inflow, so the renminbi can stabilize. Then during the U.S. China trade and economic negotiations, and we saw the pace of opening has have accelerated. Indeed, the financial liberalization is in the following areas. Number one is to lower the restriction on ownership. How much foreigners can own a Chinese financial institution. In the past, there's no majority ownership foreigners can have in China. Now that has been removed. And the second part is, China also lowered or removed the quota for foreign financial institutions to invest in China's equity and bond market. In the third area is basically, now foreign financial institutions can, participate most of the transactions in the Chinese market. For example, in the bond market, they can do repos, they can do also futures. In the equity market, foreign financial institution can do margin lending. They can also engage in, shorting in the Chinese equity market. So you can see this is a wide spread or broad scope financial liberalization.
So that's interesting that you're arguing that basically it was China's own domestic reasons. Is there also a drive to bring in some of the sort of principles around risk management and debt management, all those things? Is that another, consideration as, as China decides to open the markets?
Yeah, I think that's part of the reasons as well. If you look at how emerging market economies develop their financial system, foreign participation is often a very critical part, given foreign financial institutions have better risk management skills, they have more products, and they even bring in more financial technology to make the transactions faster. So, with more foreign participation, we will see more competition within China's financial system. It's hoped that Chinese financial institutions could also learn quickly. Indeed, we have seen that already, and even with limited foreign presence in China, Chinese financial institutions are learning quickly by providing, more products to serve Chinese households, and also their risk management skills and corporate governance are improving as well.
So maybe learning a little too quickly. We'll come back to the question of Alibaba, which was obviously expanding, and China, we all know, has become very, very sophisticated in terms of fintech and all the kinds of things that are being offered. But we'll come back to that in a second. And before I turn to you, Andrew, I do want to say that, firstly, I want to say we will take some questions at the end. So for people in the audience, if you do have questions, can you please type them into the Q&A? You'll see the icon at the bottom of your screen, and we'll try to get to them in the last 10, 15 minutes of this conversation. So, but in the meantime, before I turn to you, Andrew, so Li-Gang, you're sitting at Citi Group. So are foreign firms rushing in? And Citi, I understand, is the first foreign bank to have custody rights. Is that a big deal? Are foreign companies excited about what's going on?
Yeah, I would say that foreign financial institutions have taken this opening very positively. I just checked the statistics. Now there are about 20 foreign financial institutions are waiting in line to get approval to have their majority ownership operation in China. And major U.S. banks have already done that. Citi is in the process of applying for a majority-owned security license in China. Citi is also the first American bank being granted to do custodian business for fund operations in China. We all know that custodian business is a safekeeping and administration of securities, and the bank can provide a lot of additional services such as foreign exchange, hedging, tax services, cash management, and others. Given this custodian business in China is a $7 billion business, wow. Used to be only dominated by Chinese big four financial institutions. So you can see, this is a big thing for Citi, and the Citi has a very broad international custodian business. Once foreign institutions enter into China, it is very natural that they will also use Citi as their custodian for their fund transactions in China.
I see. Okay, so maybe we'll come back to. I do want to ask you a little bit about sort of why a Chinese institution what appeal or what advantage foreign financial institutions like Citi might have, like why the Chinese market has become pretty sophisticated. Why would they? But let's come back to that afterwards. I first want to turn to Andrew to talk a little bit about. I mean, from what I read, there are also still limits to the extent of China's opening up of the financial markets, right? And why is that? And what is the government not prepared to give up control over?
Yeah, well, Li-Gang has expressed it very well. I mean, there's been a significant opening of the financial markets. It reminds me of the entry of China into the WTO, which was even more significant than I think what's occurring now. But the problem is ultimately there's a limit to how much China wants to give up control of its financial system. They are sort of taking the playbook from Zhu Rongji in the WTO, which is to use the foreign presence to try to modernize certain aspects of the plumbing of the financial system within China, but they don't actually want to hand over the plumbing itself. Now, the foreign banks have had entry into China for several decades, and their market share at this point is, I think, 1.7 to 1.8%. It's quite limited. And most of the banks I've talked to have had difficulty getting good credits to lend to, because a lot of these are state credits that are locked up by the state banks, or often dodgy rural credits. So a lot of the entry, I think, currently, and what's going on in the future, is going to be into what I call fast money, which is essentially the investment banking business. Well, there's two kinds. There's the foreign entry into equities and into the bond market, where there's no actual control handover at that point. You simply own the security. And in fact, there's a huge dodgy element to that in terms of the access to the underlying assets those securities are based on through these keep well deeds and VIE structures and so forth. And the second aspect is the banks that are rushing in there are going to do one-off transactions like IPOs, like bond deals and the rest of it. So they make a quick buck, they turn it over, and then they move on. And if there's a problem, they don't have a lot of capital tied up, they don't have a lot of infrastructure, and they can simply withdraw, unlike significant FDI that we saw over the previous decades in autos and the rest of it, or commercial banking, which requires a huge network of salespeople in order to get the deals. So I think China is quite happy to see this money come in, both because it's additional capital. It tends to be smarter money, one hopes, although we're seeing some problems, as for example in the Warong case.
Smarter than what? What do you mean smarter money?
Well, a lot of Western investors may be taking a longer term view. They may be trying to analyze the credits. Domestic money in China is smart, but it's very much calculated according to political situation, and the Western money is going to be using a different calculus. So I don't know how you depends on how you define smart, but those are definite advantages, and I think that that's a positive both for the West and for China. But I do think that the amount of actual impact on the domestic financial system in China is going to be limited for the reasons that I stated. The state banks don't want to give up control, and for those issues.
Can I jump in for a second just to follow up to really clarify what you're saying? So in other words, when you talk about this being sort of investment banking business, one-off deals, fast money coming in, et cetera, that's as opposed to what? Like what do you not see happening when you're talking about the state banks not wanting to give up control? What is it that will still be tightly controlled?
Well, commercial banking is a difficult nut to crack, because they have to set up a large branch network, and they have to have salespeople, and they have to make long-term loans and commitments and understand the political situation. So it's a much more difficult area. And the state, remember, the state banking system has lost significant market share over the past decade, really, because of shadow banking.
Yes.
And now the regulatory system is trying to reclaim some of that. The Ant Financial situation is an example of not exactly shadow banking, but an area where the state banks felt like they were relinquishing too much control. So the core aspect of the system is the deposit base that the state banks have, which are used to subsidize loans to state institutions. So they certainly don't want to give up big chunks of that.
Right. So, Andrew, I know you've done a lot of writing about shadow banking. So can you, there are a lot of people in the audience tonight who are, in the market and know all about it, but some who probably don't know exactly what you're talking about. So can you kind of, briefly explain what that has been, the rise of shadow banking and the sort of risks that both China and Western investors are concerned about with the rise of shadow banking?
It's not that complicated. I mean, in the financial crisis in the US was shadow banking, but that was essentially concentrated in the Wall Street and in the financial markets. Instead, in China, shadow banking is essentially lending, but using financial institutions that are less well controlled or less well regulated. Some of them are, even the banks have gotten involved in it, but also a lot of non-banks and small institutions. A lot of this came up because of the financial stimulus in 2009. Where a flood of money went into the system, and the state had to find a way to get this money out to people, and the state banks weren't doing it fast enough. So a lot of other institutions came up. They still exist, and one of my arguments is that they can't put the genie back in the bottle. Once you pour that many trillions of yuan into the market through all these other institutions, it's hard to stop them.
And is the state still intervening in the financial markets? So can you talk a little bit about the recent, the blocking or whatever of the Alibaba IPO? what is that all about? You know, and talk a little bit about the current issue with Huarong, the government deciding to prop it up. Tell us about in what ways are they signaling that they're not really, you know, ready to release the reins? And then Li-Gang, I'd love to get your thoughts on this too. But
well, the Huarong and the Ant thing are basically tips of the iceberg. I mean, the state intervention is throughout the system in various degrees, but it's a complicated subject. The Ant situation was relatively simple. Jack Ma made a speech, annoyed a lot of senior leaders. As far as I can tell, and Li-Gang may have a different view of this, the PBOC, the central bank, jumped in because they sort of felt like Ant was getting too big in the payment space and was also arranging tons of loans for small banks. But the banks had the balance sheet risk, even though Ant had arranged the loan. So there's a lot of nervousness about Jack Ma and what that meant for the financial system. Huarong is a little different. Huarong is a bad bank set up 20 years ago to help out the state banks with their non-performing loans. And essentially, Huarong and the four other large AMCs weren't doing their job. Most of them are owned, majority owned by the Ministry of Finance.
AMC
and yet
being asset management companies.
Yeah, I'm sorry. Okay, Huarong Asset Management Company. I mean, they're not asset managers in that sense. They're basically financial institutions doing a bunch of stuff. But they were supposed to unload these bad loans, and they did a pretty bad job of it. And all of a sudden, Huarong found itself caught with a near default situation.
Okay.
And the problem in China is that a lot of Western investors assume that every credit is ultimately backed up by the central state, and that is just not true. And even in a case like this, which 58% owned by the Ministry of Finance, there was a lot of hemming and hawing in Beijing, sort of saying, well, what are we going to do about this? And investors got spooked. So there's always a question of the moral hazard. You know, what is a state willing to back? And the state loves to say, okay, well, we're going to do this for symbolic reasons, but much of the system we're not going to back. And so everybody's always guessing, and this is going to go on for some time.
Right. So Li-Gang, I'd love to hear your thoughts on this, because you've talked about, you know, that there's not just, I think we in the West tend to think there's sort of one China, you know, and it's the government, and the government does this, and that's it. But I think that when you start digging a little bit deeper, it seems like in particular with these kinds of issues, you find that there are different ministries who have different agendas and have different jobs, basically. And there may not be complete agreement about what the policies should be. So what do you see? Can you talk a little bit about this? You know, maybe take the Huarong case as an example, but, you know, talk about the issues that various government agencies are kind of dealing with to get past the nuance. I mean, to add.
Yeah, I think you know, like the U.S., you know, China has its own, you know, central bank and the regulators. Their role is to you know, conduct monetary policy and provide financial regulation. And you know, overall, I think they have done a reasonably good job. You know, China did not have a major financial hiccup. You know, even during the last global financial crisis, you know, now I think overall we expect financial stability will be there and can be maintained. The issue with Huarong is that you know, the big AMC, one of the big four AMCs, as Andrew mentioned, did not issue its financial report on time. And together with you know, the leader, you know, the chairman's taken away, you know, sentenced to death, that really spooked the market. You know, people are quite concerned whether Huarong can honor its US dollar credit bond or Chinese renminbi bonds onshore. And so this is the concern at this moment. You know, China has been experimenting with increased SOE default over the years. You know, the SOE default is no longer something we have not seen before. You know, we have been seeing more SOE default lately. But last year, we did have a rather important SOE defaulting its credit bond. You know, this is SOE in the coal sector from the Henan province. In November, it defaulted its credit bond, and then it sent a big shock to China's financial system. The reason is that we all know, in the China's credit system, people tend to think that SOEs are less willing to default, especially if SOE has good assets. They should honor their debt. The Yongmei case, as I mentioned, this coal company, basically is a type of malicious default. It has a lot of assets. Before it announced its default, it's transferred the assets to Henan province SASAC, the agency to manage state assets. So this then set a very bad example. That is, if such a SOE cannot honor debt, investors are worried whether those private entrepreneurs will follow the suit and do the same thing. And as a result, we saw a big shock in the Chinese credit market. Many SOEs could not issue debt for a while because of this case. So now, this case actually is very relevant to how we think about Huarong going forward. As Andrew mentioned, Huarong is 58% owned by Ministry of Finance. Investors all know that Chinese financial ministry is well endorsed. It has a lot of resources, and 3 trillion Chinese foreign exchange reserve should also belong to the state. MOF should own it, right? So if Huarong can be allowed to default, this means that investors will worry whether another big size, the Yongmei case, will take place. So the implication on China's financial system will be much bigger than we think. So my view is that to handle this default, the authorities need to take a very cautious approach. If they don't manage it well, we may see some kind of spillover effect, which may then affect China's financial stability.
Okay, interesting. So Andrew, what do the markets want? I mean, do they want China to allow defaults like this? Or what would be the economic risk for investors and in the market? I mean, and then I want to go back to Li-Gang and sort of, how different ministries are looking at this differently. But yeah, what do the markets want?
Well, the markets that don't object to defaults per se, they just want an environment where the rules are known. And unfortunately, with the moral hazard of state ownership in China, those rules are not known. And in effect, they cannot be known because much of the system, including local government debt, local government financing vehicles, which are investment firms basically for local governments, there's a whole host of institutions that rely on the assumption of state backing in one way or another. So if China were to come out with the rules saying, okay, these are state credits, these are not state credits, the whole system would collapse. So it's a bit of a shell game going on. What they're doing, and I think Li-Gang expressed this, is they're actually kind of warning people. They like to sort of prod people and say, okay, look, you really have to take a more careful look at these credits and before you make an investment decision. But they then pull back because they don't want to set off the alarm bells of financial contagion that
wait, I'm a little confused. Hang on 2 seconds. So you said, when you say they're telling people they need to take a look at credits before, who are they talking to?
Well, bondholders onshore and offshore.
Okay.
So with a situation like Huarong or some of the other credits, they'll be very slow about saying what they're going to do about it. Partly because there may be internal debates, but also because I think, and maybe Li-Gang has a different view, that they're testing the waters to see, okay, how much pain can the bondholders and other lenders of capital and even equity holders take in this situation. And then that's forcing the market onshore and offshore to sort of say, okay, so what is the actual underlying fundamental economic value of this credit? instead of just assuming that, it's state backed, maybe we should look more carefully. So the offshore ratings agencies in the past 5 years have gotten much better at saying, what the cash flow is and the rest of it. Like 10 years ago was sort of the assumption everything was owned by the state. So and then even in the court system, there's been a huge increase of defaults for small business. So there's an attempt to really regularize this, but as I said, they can't do it overnight because the whole system would collapse.
So Li-Gang, a question for you. I think you'll probably think that we tend to oversimplify things in the West, but and sort of China watchers often tend to look at things in terms of reformers versus non-reformers, that kind of thing. But yet there are different vested interests and different groups who are, pushing for different things. So I wonder if you can walk us through that a little bit, because a lot of it's very logical, right? I mean, it makes sense that certain, who would like to push faster with defaults and this kind of thing? Who, I don't mean names, but I just mean which kinds of institutions would be pushing for that, and where do you see the sort of tensions in terms of policy?
Yeah, I think, from the regulator's point of view, if they want to push to set up a better credit culture in China, they probably would like to see some defaults. If you look at CSRC, China's equity regulator, and the CBRRC, banking and the insurance regulator, their view is that some default could be healthy to help build up China's risk management system and credit culture. And also, if you look at China's financial sector, default rate is still very low. For example, in the bond market, on average, the default ratio is only 1% of the total assets outstanding. In the United States, it's 4 to 5%. So you can see that China could allow more default down the road, but on the other hand, from the financial stability point of the view, right. The PBOC is also concerned about whether you allow such kind of a default, what will be the negative consequences to financial stability as a whole, right? Whether you will inadvertently, lead to some kind of contagion effect. Huarong basically has, bond issued. A lot of major financial institutions are the holders. Small, medium financial institutions may also have a lot of Huarong bonds. If you allow that this major institution to default, whether you will trigger some kind of contagion effect, certain small, not well managed financial institution could also go under. And so this then set off quite a serious financial shock, given China's economy is still recovering, and perhaps from the financial stability point of view, the regulators together with the PBOC may not want to see such a big sized default at this stage.
I want to go back to something I think that you were saying, Andrew, which was you were drawing the parallel with Zhu Rongji and China's entry to the WTO, and that one of the sort of driving ideas behind that, or was that some foreigners coming in will bring a positive kind of pressure to China's economy, et cetera, and will help China to modernize in a sense, and yet without sort of giving up all control, right? There was still all kinds of controls in terms of foreign companies having to do joint ventures and having tech transfers and all this kind of stuff. What I wanted to sort of posit for a second is that from the Chinese perspective, that worked pretty darn well, didn't it? I mean, no? Okay, you're shaking your head. So that, yeah, okay. So I want to hear you guys discuss. What I was going to say is it did pretty well for China. China's economy has been roaring ahead and has modernized tremendously. So while I can understand Western financial institutions feeling frustrated that China is not opening its doors more quickly, is there an argument? What's the downside for China? I mean, is there an argument that actually it could work pretty well for China? So you're shaking your head, so go ahead.
China was able to do that because Zhu Rongji was in a very powerful position, and he was able to force the banks to modernize and get them listed, and also reform the state sector more significantly than has occurred since, basically.
Yes.
And as a result of that, the entry, foreign firms, in my view, have probably had the most market share they'll ever have in China for the next several decades, in the JVs in the auto industry and a lot of other areas. The downside problem was 6 million people were laid off, particularly in the northern provinces, and they have basically been unemployed ever since then.
Yeah.
And from the point of view of effective, reorganization of the economic system, it was very positive. I agree with that. But from the point of view of a lot of people, it hurt them quite badly. I would argue, and this is a contestable point, that Xi Jinping actually lacks the power to do that now. Even though he's considered the most powerful leader since Mao, I actually think that he is less powerful in many ways than what we saw back in the Zhu Rongji days. And that also the financial system has grown so large particularly since the stimulus in 2009, that Zhu Rongji's ability to, I got my leaders mixed up. Xi Jinping's ability to make decisions about reform are much more constricted, which is why Li-Gang and I are talking about this dancing around the state ownership issue, because they can't really touch a lot of these things like local government debt, because a lot of places would collapse. So reform is happening, and as Li-Gang said, it is quite significant that they've had this growth, that the PBOC really knows what it's doing, and that they've tried to tamp down the fires of contagion and shadow banking and interbank lending and so forth. But there's a limit to what they can do given the imperatives of the system right now.
What do you think, Li-Gang?
Yeah, I think financial sector reform is a quite complex process. Unlike the real economy, you can open up or you can bring in stable FDI and you can operate the factory. In the financial sector reform, you need to look at whether your financial institutions are ready, whether your regulatory capacities are there, whether you have the right legal system, credit rating, and all sets of soft infrastructure. And this will take time. I think perhaps China's delay in opening its financial sector for foreign participation is based on these considerations. But from now onward, we think that the conditions are quite ripe for faster liberalization in China's financial system. There are a lot of statistics. China's equity and bond market are already the second largest. China is already the second largest economy in the world. China also has a huge amount of saving because of the state financial system dominance. The savings are not well utilized. In China, you often hear the word that finance should service the real economy. But if you look at the performance of Chinese financial institutions, they still offer very high cost of loans to Chinese firms. The weighted average lending rate, benchmark rate put out by the PBOC is still at 5.08% by end of last year. Whereas in the rest of the world, we have a very low interest environment. So you would think that because of this huge inefficiency in the Chinese financial system, to some extent, the Chinese real economy have been hindered by such kind of inefficiency. So it hopes that with foreign participation, more competition, and China's financial system could become more efficient. So I think there's no doubt, China's this round of financial liberalization is quite real. Despite Andrew's frustration on SOE reform, which is true, I think, and we do see the last 5 or 6 years financial market opening has been really fast.
Mm. So, before we turn to questions from the audience, we still have a few more minutes. I wanted to return to, you were talking about the high interest rates and the lending inefficiency, and what isn't it? I mean, the shadow banking and even Ant Financial, the work Ant Financial was doing, and other institutions, weren't they serving a very important role in terms of helping the private sector? That had so much trouble getting loans from the state sector, right? And so I want you to talk about that a little bit again, because it sort of adds more nuance and complexity to the whole picture.
Yeah, I do agree. China's shadow banking system had serve a lot of non-state sector because China's interest rate used to be controlled, given the state ownership. State-owned financial institutions are more willing to lend to SOEs than to POE. So this gives rise for China's shadow banking sector. Those are the finance companies, fintech companies, and things like that. But this sector also has grown too big, too fast, posing significant risk to the overall financial system. So I think that the regulatory tightening since 2017 is a correct approach to somewhat reduce the risk. But as we know, shadow banking activities are always there, even in the United States. A well-functioned financial system, you do see a lot of shadow banking activities. And so we should not see an overkill in this sector. And perhaps the right approach is to bring those shadow banking activities into the regulation area, so that they follow similar capital adequacy rule and don't provide the usury type of interest rate, and so then the risk posed to the financial system will be less. I think this is the reason I'm not that pessimistic that like Ant Financial, it's very useful institution to serve a broader segment of the Chinese private economy. And there are a lot of studies showing that Ant Financial has been promoting China's interest rate liberalization. They expand the scope of the household they can lend to, and has made the financial inclusion more broadly in China. And so our sense is that despite this stoppage in IPO, this institution should have a bright future.
Do you pretty much agree with that, Andrew, or do you see things differently?
I mean, I agree that Ant has been very positive for the Chinese economy, and it's distributed capital to small borrowers across the country. In terms of shadow banking overall, I would differentiate between companies like Ant on the large service side and a lot of the local state institutions that are shadow banks that have 50, 60, 70 trillion worth of assets that the state is concerned about touching. And the state cannot de-risk that, because de-risking it would mean reducing their assets, and they can't do that because the local governments need it. The state, as Li-Gang said, has been, PBOC and so forth, have been very good about regulating other parts of shadow banking, like the interbank market and so forth. But in terms of the future of Ant, it's pretty clear that the leadership, the State Council and the PBOC have got very nervous about the degree of power that Ant and other companies had. They didn't like the fact that sure, there were risks there. There were some real risks that Ant was running, but a lot of it I think had to do that Ant had the customer base, and all of a sudden small banks across China were relying on a single company for a lot of their customers. And in addition, Ant controlled the payments market to a large extent, along with some other companies like Tencent. And China is sort of saying, well, okay, once again, the financial plumbing, you've got too much of it. So now they're now trying to regain control of the data that Ant has. They're trying to essentially reduce the degree of the scope of its business. They're digitizing the yuan internally as a way for a number of reasons. One is because they can increase the information about monetary policy, but also it means they know where the money's going, so they can control money flows. And that means people can't launder or have corrupt money as much. And they're trying to do this internationally, but that's not going to go too far because of lack of convertibility. So it does look like that there's a political attempt to protect the state system, because the state feels like if it loses control of the money flows with the core area, then its legitimacy would be put under question. So I agree with Li-Gang that it will go ahead with its IPO, but its wings have been clipped, and already Fidelity, I think, significantly wrote down their ownership stake in Ant based upon a new valuation.
So a last question before we turn to questions from the audience for you both. Is I wanted to ask you, as China's financial markets continue to open up, what do you think are the biggest opportunities for investors in foreign financial institutions?
Yeah, I would say that China's financial market perhaps is the last frontier in globally, right? For U.S. and the Western financial system, it poses a lot of opportunities. As I mentioned, China's savings ratio is very high, one of the highest in the major economies, still at around 43 or 45% of GDP. And China's equity market and bond market are the second largest in the world. Perhaps in the 5 years' time, China's financial system could be as large as the U.S. financial system. And so you can see the opportunity is huge given the comparative advantage the U.S. economy has. It's very much concentrated in financial services and the services sector in general. Indeed, Western financial institution could take advantage of this opening, and by participating in China's financial system, it's a win-win situation, right? Chinese household in the future will have more investment products, especially those global products that can invest in. They can diversify their renminbi asset risk, right? Meanwhile, Chinese firms could gain as well, and perhaps their funding costs in the future will gradually decline. And so as a result, productivity in China's economy could increase.
Yeah, Li-Gang is absolutely right. I mean, there's a huge opportunity, and we're seeing that. Western investors are pouring cash into China despite the trade war and everything else. The two issues I'd pose as being a voice of doom. First is the macro issue of whether you are concerned about systemic risk and financial risk and a contagion. For example, a collapse in the property market, which has been in a bubble for quite some time and being propped up by the government. And the second area is sort of the micro element of accounting standards within China, and also the legal structures of access to assets through these keep-all agreements that really have no standing in law, or the VIE, variable interest entity VIE structures where the foreign investor doesn't really own the assets within the country. There's a lot of issues, and the third issue is capital flight. I mean, if Westerners pour a lot of money into China, and if there's some concerns that arise that the government cannot control, is China really going to allow $500 billion to exit the country with that kind of fast money? And if they can't, what do investors do at that point? What's their view? But overall, I think that, China should be a much bigger part of total investment allocation, and we're just going to have to figure that out.
Interesting. Yeah, we did do a program about IPO listings, China's IPO listings in the States, and what's going to happen given U.S. U.S. restrictions on and accounting requirements on IPOs, and there was a lot of talk about the risks that are sort of not really talked about a whole lot in terms of what the real ownership is and whether you can have access to if you are an investor in I see a couple questions from the audience that are all of which are related to China's push for digital currency. I do see a question. I'm very happy to see Al Reyes there, who is an old colleague of mine, wonderful economic writer. So he's asking, can you comment on the internationalization of the renminbi in the context of the development of the yuan, the digital currency? So can you guys talk about that?
Yeah, maybe I answer it, and Andrew can complement with what I said. I think we should not put a lot of hope on digital currency development in China that could promote the renminbi internationalization. I think the purpose for China to develop its digital market, digital currency, especially PBOC is doing that, is exactly doing what Andrew has been saying. That is, if you look at China's electronic payment system, is very much dominated by two large ones, Tencent Pay and Alipay, right? And by dominating the market, they also got a lot of customers' personal information, and by now given big data, such information will further their business and the commercial interest. And so somehow the PBOC's venture into this is to provide some competition in this digital payment market, and by doing so, it could also rein in the irregular usage of customer data, right? So as to whether China's digital currency will go abroad, it will depend on how other countries can have its own digital currency system, and there are a lot of regulations surrounding this cross-border digital payment. If those are not there, it's very difficult for China to push that single-handedly. As to renminbi internationalization, I think this is a real process. We have already seen a very fast progress since its formal launch in 2009. And now renminbi is the third largest trade financing currency in global payment. Its ranking has gone up for quite a lot. Our view is that in 10 years' time, perhaps renminbi could become the third largest global payment currency. But then, if you compare its role with the dollar, the euro, the renminbi share, according to us, is no more than 9%. So it's still a very long and gradual process. The major impediment for China's fast renminbi internationalization process is its unwillingness to open up its capital account. As Andrew mentioned, that the authorities may not want to see large and sudden capital outflow, right, which will definitely have major implications on financial stability in China. So in that sense, I think this capital account liberalization will still be there. I want to mention that despite China is opening its financial services for foreign participation, its capital control remains there. And basically, this is something is also risk factor foreign financial institutions operating in China should think about?
So if you guys were, I'll let you answer too, Andrew, but I wanted to just jump in. If you guys were sitting in Beijing running the economy, would you also, keep the capital controls? I mean, the thought of releasing capital controls must be awfully scary if you're sitting in Beijing, in Zhongnanhai.
Well, yes, it is scary, and I don't think they want to do that. And I think that the idea of people within the country moving money out and then lots of investors coming in and having huge chunks of the financial system just would be untenable. So I think that they're right to remove it slowly. In fact, the way they've been doing it by tunneling through with things like Stock Connect and Bond Connect in Hong Kong, and the QFII program and the QDII programs to allow money in to come in has been actually fairly astute. They've basically given very controlled ways for people to move money in and out.
What are those programs that you referred to? I'm sorry, what does this?
Well, QFII allows foreign investors to buy the domestic A-share market, but you have to register, and it's a fairly controlled process. QDI is the same thing for going overseas, and Stock Connect is where you can go through Hong Kong and buy stuff in China. So it's actually been this, but it's a very slow process. And overall, the RMB, it has grown internationally, but in effect, most of that is with a small group of trading partners. So there's not a lot progress there, and it's going to be a while before they get anywhere. I did want to respond to Al Reyes's other point about Hong Kong, the future of Hong Kong as a financial center. And I'm certainly quite negative as a person who's been here off and on for 20 years. Essentially, Hong Kong has been mainlandized. A lot of the savings deposits now are owned by Chinese institutions. A lot of the transactions are done by Chinese institutions. Shenzhen is making a lot of noises about trying to compete with Hong Kong. And as the legal system is slowly eroded, then there will be probably far less interest in conducting business here. Companies probably will move either to Singapore or go onshore to go to Shanghai. So I'm not terribly optimistic, but there's a lot of Chinese money. So it's not like the capital will leave. It just might be replaced by domestic capital.
Mm-hmm. So, but that suggests that if it's replaced by domestic capital, that Hong Kong still could continue to be a very important, international financial center, right?
Well, if you don't have a lot of international banks with US dollar flows conducting business here. I mean, if it's basically going to be Chinese institutions with sometimes doing currency conversion at the behest of Beijing, there's political aspects to that. And if the sanctity of contracts starts to be questioned, which hasn't happened yet but could happen, then I think that it reduces the value of Hong Kong as a financial center.
I'm curious as to what China loses if Hong Kong, in the future is not a vibrant financial center. What does China lose? China loses quite a bit, doesn't it?
Li-Gang, what do you have?
Yeah, I would say that China still view Hong Kong as a very important international financial center. Yeah. Lately, in China's economic policy, there's a term called the dual circulation economics. That is internal circulation as the main driver, but internal and external circulation should mutually support each other. This means that China will not ignore the external circulation, and I think Hong Kong still can play a very important role. As we both agree, Andrew and I think that China's capital control will remain for a while, right? As long as capital control is there, and Hong Kong should have a special role to play. I would think that maybe it's too early to write Hong Kong off. Some investors wrote Hong Kong off once Hong Kong returned to China in 1997. Now we need to be patient. I think Hong Kong has a lot of advantages. China's financial market still does not have, the legal system which adopt this British legal system, right? And there are still a lot of foreign judges working in Hong Kong's court system. And so if you want to arbitrate a case, perhaps many investors would like to choose Hong Kong rather than the court in mainland China. So you can see that Hong Kong's role will continue to be there, and it matters also for Hong Kong government itself to think about how to reinvent itself to make Hong Kong's industrial structure more broad-based rather than only concentrated on finance and trade, and so that in the future, a lot of young people can have a high salary jobs, so that this income inequality can be narrowed, so that the social issue could be better managed. And so I think, indeed, I think Hong Kong does have a big role to play in the future, even by looking at the recent American Chamber of Commerce survey on firms in Hong Kong. Majority of American institutions still express that they want to continue to stay in Hong Kong and do business here.
So our time is basically up, but I just wanted to give you both a chance. Like, Andrew, do either of you have anything else you wanted to, throw in that I haven't asked you, or that you wanted to say before we conclude tonight?
The only thing I'll say is that I've been participating in a lot of talks involving the U.S. institutions, and as you can tell, I have my concerns about reservations about the Chinese economy and so forth. But I'm also dismayed at the hardline reaction in Washington. There's a lot that should be done in opposition to China, but it seems to be policymakers in the United States have gotten quite fixed in their positions, and I would prefer a little more flexibility.
Yeah, thank you for that. That's, I think, a very helpful, broad comment. And what's so interesting about this conversation tonight, I want to thank you both so much, because you really did add so much nuance to a discussion, and helped me certainly understand just how complex the situation is in terms of, how fast China can or wants to, or whatever, open up its financial markets. And it's very, very helpful to have you add this kind of nuance. So thank you for that. And I also wanted to say that just to show you the sort of breadth of the kinds of programs that China Institute does, tomorrow we have a Pieces of China, just 15-minute episode with Aurelia Campbell, who's a great expert on the Yongle Emperor. So she's going to be talking about the Yongle Emperor who built the Forbidden City. And then in a couple of weeks, we're going to have another wonderful business program about the biotech frenzy in China. And, whether it's a bubble and what will be happening in the future, what are the prospects for, U.S.-China collaboration in the biotech sphere, et cetera. So again, Andrew and Li-Gang, I want to thank you so much for your brilliant insights, and thank you for sharing them with us. And to everyone who's tuned in, thank you so much for joining us this morning. Please become members of China Institute, because your membership really allows us to bring these brilliant speakers to our stage. So thank you. We hope we can get you both back again sometime soon. Thanks.
Thank you.
Thank you, Linda. Thank you.